but we entered into a partnership with the Chicago Board Options Exchange to roll out a series of futures contracts based on some technology. So in the very beginning, we talked about I did the next as a parallel tranche securitization. Remember, the idea is what are things that the market is doing in fixed income that might make sense to kind of explore in the equity asset class. So IOs and POs are parallel tranche securitization. The next thing we wanted to tackle was sequential tranche securitization, which would be CDOs, CLOs, things of that nature, where I take a pool of assets and I basically carve it up into performance tranches. And if you really think about what is a CDO, right? It's a series of better of and worst of outcomes. And the senior, when you capitalize a pool of assets, the senior lenders get the best performing bonds, right? Said differently, the equity tranche gets the worst performing bonds. The first default eats into the equity. And as long as you don't have enough bad performers to eat into the collateral that's really sitting behind the senior tranche, then the senior tranche is fine. So we wanted to think about how do we do that strategy. So we applied that same approach to equities. So we built an index, without getting into all the technical stuff. It's basically a 100 stock index. Each stock is equally weighted. The sector weightings are interesting. So the index itself actually has it's very highly correlated to the S&P 500. So we have this, that's the master index. And then we have, off the back of that, there are two sub-indices. One index is called the lead index, and the other one is called the lag index. So if you think about it, the master index,
two tranches,
the best performers and the worst performers. And so the master index is a total return index where all the corporate actions are captured at the constituent level. So not reinvested across the index. And it's a horse race. And we run it for a quarter. And whatever the 50 best performing names are, I don't know what they're going to be until I get to the end of the quarter. Those names will sit in the lead tranche. Everything else, the 50 worst names will sit in the lag tranche. And so what is
as an index, and then there'll be futures on that index.
Well, we're going to list futures on the lead tranche and the lag tranche. So if you go to any investor and you say, okay, 3 months from now, would you rather own the best performers or the worst performers? Most people would just instinctively say, well, I'll take the best performers. Okay. The question is, how much are you willing to pay for that? So on day one, the NAV of the index is 100 and the two tranches are 50 and 50. I don't know what names are in it, but each stock's worth $1.
Right.
As they move around over time, the NAV of each of the tranches has to equal the NAV of the index. The futures contracts, if the lead tranche is trading at a 5% premium to NAV, then in an arbitrage-free model, that means the lag tranche has to be trading at a 5% discount. Because those two have to also add up to the NAV.
To the index. Right.
So that's realized dispersion. It's realized return dispersion. It's leveled down. So most of the correlation indices and things like that look at implied vol between the index and the constituent stocks, those are all implied to implied, but none of them have a realized outcome. And we actually have a realized outcome here. So you'll have a return. There's a beta in it or a delta in it. The pricing of the futures contracts will have to capture the implied vol in the market and the implied correlation in the market because it's basically a better of than a worst of option, if you want to think of it like that. Right? Over time, they're going to converge. But what's unique is it actually allows you to express a directional view as well.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCM Alts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.